Uranium isn't just another commodity. It's the most misunderstood energy bottleneck on. Hey everyone, my name is Anthony Fatsies, and welcome back to another episode of the What the Finance podcast. Today's episode is a special one because we're diving into a sector we haven't really explored before. I'm joined by Justin Hun, the founder and publisher of Uranium Insider, and one of the most respected voices in the uranium space. Justin, thanks so much for coming on the show. My pleasure, Anthony. Thanks for having me. Absolutely. I'm really looking forward to this conversation. It's actually the first time we've spoken, and uranium is a topic we haven't covered on the podcast yet. A lot of people find it interesting, but also confusing. So maybe we can start very high level. If someone knows almost nothing about uranium, how would you explain the uranium market, what drives it, and what key dynamics you pay attention to? At a very high level, uranium is the primary fuel source for nuclear energy. It's also used for highly enriched uranium in nuclear weapons, but the market we focus on almost entirely is nuclear power. Uranium is a very unique commodity. Like most commodities, it's cyclical. You get brutal bear markets, followed by explosive bull markets. Low prices eventually cure low prices because production shuts down, and high prices cure high prices because supply comes back. That's true across commodities, but uranium behaves a bit differently. The big difference is timing. Uranium cycles tend to last longer and move more violently because the mining industry responds extremely slowly to price signals. You're dealing with radioactive material, heavy regulation, and a limited number of safe, supportive jurisdictions where uranium can even be mined. On top of that, uranium goes through a long fuel cycle. After it's mined, it becomes U-8, yellowcake, which then has to be converted into a gas, enriched, converted back into a solid, and fabricated into fuel rods. That entire process can take anywhere from 1.5 years to 2.5 years. Because of that long process, nuclear utilities hold large inventories. They don't rely on just-in-time delivery like a coal or gas plant. That inventory buffer can hide supply shortages for years. So during bear markets, prices collapse well below production costs and stay there. During bull markets, prices overshoot far above what's needed to incentivize new supply. That's why uranium markets are so extreme. Historically, the volatility has been incredible. In the last major bull market from around 2003 to 2007, uranium went from under $10 a pound to $134. Some uranium stocks rose 5,000% to 10,000%. Then the price collapsed again. More recently, uranium bottomed in late 2016 around $18 a pound. Since then, prices have been recovering. We're now around $75 in the spot market and roughly $85 to $90 in the long-term contract market. But even at these prices, the industry still isn't incentivized to build enough new mines. At Uranium Insider, we've built very detailed models of the entire industry. We track every operating reactor, planned reactor, life extension, and shutdown, and compare that demand against every mine that's producing or realistically could produce. What that shows very clearly is a persistent structural supply deficit that's likely to last many years. Even if prices double tomorrow, it would still take 3 to 5 years for new mines to come online. That's what makes uranium so unique and, frankly, so compelling. Another major driver right now is global electricity demand. AI data centers, electrification, and energy security concerns are all massively de-risking nuclear power. Demand for uranium is growing around 3 to 4% annually, and we simply don't see where the supply is supposed to come from at current prices. Of course, politics plays a huge role too. After Fukushima in 2011, uranium went through a brutal decade. Reactors were shut down, Japan sold inventory into the market, and investor sentiment collapsed. But politically, the situation today is almost the opposite. Even in Japan, public support for nuclear power has recovered. Reactors are being restarted. Countries that shut nuclear down, like Germany, are now facing high energy costs and rising emissions. In the U.S., nuclear is one of the few things both political parties actually agree on. Russia and China are often mentioned in the uranium conversation, but neither really corners the supply of uranium itself. Russia dominates conversion and enrichment services and exports reactors around the world, but it doesn't have much uranium in the ground. Russia is actually a net buyer of uranium and even a net buyer of converted material, despite being the largest converter globally. China is rapidly building reactors and supply infrastructure, but its uranium production largely just keeps pace with its own demand. Both countries still need the raw material. When you look at the economics of mining uranium, it becomes clear why supply hasn't responded yet. Kazakhstan is the lowest cost producer using in-situ recovery mining, producing uranium for well under $50 a pound all in. Canada's high-grade mines are more complex and expensive, but still competitive. Outside of those regions, costs rise quickly. Many projects in the U.S., Namibia, and Australia need prices north of $100 a pound to justify construction. Even today, at $75 spot and $85 term, most producers are barely breaking even. Some are selling uranium at prices above their cash costs, but still losing money once you factor in sustaining capital and overhead. That's why companies like Cameco are holding firm in contract negotiations. They're telling utilities that future contracts need floors in the $80s and ceilings well above $120 or $130 per pound. Utilities don't like that, but the reality is simple. Without much higher prices, the uranium just won't get mined. That's really the crux of the uranium story. Demand is real, growing, and highly visible. Supply is constrained, slow to respond, and underinvested. And the price needed to fix that imbalance is meaningfully higher than where we are today.